Hello, this is Scott with Ghost Trades, and today is Sunday, June 7th, and I want to talk about a few warning signs you should be keeping an eye on in this market. So the S&P 500 has been hitting all-time highs, and on the surface, everything looks great. But beneath the surface, there are several warning signs that you should be paying attention to. First is the 10-year Treasury yield. Historically, whenever the 10-year yield moves above the 4.5% range, stocks tend to struggle. Higher yields makes bonds more attractive and increases borrowing costs throughout the economy. As I'm recording this, the 10-year yield is back above that level. The second warning sign is market breadth. While the S&P 500 is making new highs, nearly half of the stocks in the index are already trading below their 200-day moving averages. In other words, a small group of mega cap stocks, mainly the AI and tech leaders, have been carrying the market higher, while many stocks have already started weakening. Goldman Sachs recently noted that the average S&P 500 stock remains well below its own all-time high, creating one of the widest gaps between the index and the typical stock in decades. The third concern involves systematic trading funds known as CTAs. These are computer-driven funds that buy when prices rise and sell when prices fall. According to recent estimates, they're heavily invested in stocks right now. If the market starts breaking down, these funds could become forced sellers, accelerating downside momentum and creating a feedback loop of additional selling. So kind of a snowball effect. A couple of other things you should probably note is that the market's way overbought. No market goes straight up or straight down. And if you look at what we've done recently, most technical indicators are saying that we're overbought. Also, it's a midterm election year, historically the worst seasonal stretch for stocks. Also, we've got problems in the Middle East. The Strait of Hormuz is still effectively closed. Energy costs are feeding directly into inflation, and there's really no deal in sight. And any one of these things all by itself is a little bit concerning, but there's a lot of factors starting to stack up to be cautious. This doesn't mean you should panic. It means you should be selective. Focus on quality setups. Manage risk carefully. Take profits when appropriate. And remember that a market making new highs doesn't necessarily mean every stock is healthy underneath the surface. The biggest lesson? Don't just watch the index, watch what's happening beneath it. Sometimes the strongest warning signs appear long before the headlines catch up.